So my name is Shelley O'Donovan. I teach at the Wharton School. I also have my own small business called the Authentic Influence Group. You can find me on LinkedIn if you want to learn more. But I'm really excited today to moderate this panel on private equity. So I'm actually going to let our presenters introduce themselves because I'm sure I can't do them justice. So Marco, we'll start with you.
Well, thank you for being here, inviting me again. It's been a while. Just got back myself from Europe. In terms of what private equity means to us as a family office, being a fourth generation, it's just really diversifying co-investments with other families and funds, and just synergistically finding companies that can optimize our current businesses.
I'm Gaurav Mehta.
It's a pleasure to meet all of you. And Marty, thanks for having me on the panel again. I am the managing partner for Mayshot Capital. We are a healthcare-focused private equity firm that invests in growth stage through buyout companies. We have a portfolio of 3 companies today. We're about to close on our 4th next week, so not saying much right now. Yeah, we're looking forward to this panel, and it's a pleasure to meet all of you.
Hey, my name is Azar Quader. I'm the founder of Queens Court Capital. Marty, great to see you. Thank you for inviting me. I've been an investor in lower mid-market private equity for over a decade now. Queens Court has multiple platforms. We've deployed close to 200 million of capital across a number of platforms. We focus on lower middle market, combination of roll-ups and special situations.
And I don't want to forget Jack on the Zoom there.
Thank you, Shelley. I appreciate it. I'm sorry I'm not at the conference. I love attending this conference. It really is my favorite. And being there in person makes a big difference. So I'm sorry I can't be joining you folks. I'm with Empower Growth Capital. I am an independent sponsor. I've been in private equity now for about 20 years. Before that, I was a lawyer, litigated, and then did M&A work in Silicon Valley, and eventually went back to school and got my MBA from University of Pennsylvania. Yay, fighting Quakers. I don't know. And moved into private equity. So a lower middle market, primarily recurring revenue, and virtually all of my investments are minority investments, meaning less than 50%. I back the management team working and help them build the company.
Excellent. So Marty and I were saying earlier that all roads seem to lead back to Penn. So another Penn alum here on the Zoom. And Jack, with that, I'm going to kick it over to you to just tell us a little bit about your thoughts about just PE and maybe the outlook coming up in 2025 or even longer term than that.
Yeah, no, I'm happy to. Thank you. It's been a very, I think as many people are aware, it's been a very rocky period for early stage private equity. Last year, to use a technical term, it sucked. It was hard to raise capital. It was hard to deploy capital. It was a very challenging period of time. Even some of the largest funds did very few deals. They did add-ons to bolster their current portfolio companies, but they really didn't put out a whole lot of capital for new investments, primarily because of interest rates, because of inflation, because of the disconnect between valuation from what the sellers were wanting and what the buyers were willing to spend. This year has gotten better. It's not great, but it's better. Just this last week, I issued a term sheet last week. I'm going to be issuing a term sheet this week. And at the same time, I had 2 different family offices reach out to me and say, hey, we haven't seen anything from you in a while. What have you got? Which it's nice to have both ends, both the fundraising side as well as the investment side be, much more active than I'd seen for a while. So I'm keeping my fingers crossed. Things look better.
Great, excellent. So any of our panelists want to chime in on that question? Anything to add?
It definitely seems like there's been an increase in animal spirits. I think the combination of rates coming down, allowing for financings and things. There's also been more exits in private equity. I think that's going to increase. And so as investors look at where they're seeing DPI, things like private equity has been one of the better strategies for DPI as opposed to venture or growth or, other types of strategies in private markets. So I think it's going to be a good year. Animal spirits with the election and things like that are going to be solid. Our focus is, we buy boring businesses typically that Amazon or AI can't replace, and we're buying stuff at pretty low free cash flow multiples, and we continue to believe there's ample pickings in that area. On the upper side of the private equity, like higher, upper middle market or leverage buyouts or those types of deals, I think that's going to continue to be a little bit more challenging. But the stuff that are kind of lower middle market or a little bit under the radar, I think are interesting areas to invest.
Yeah.
I mean, from a family office perspective, with anything related to private equity, what we've seen is trends in green tech, sustainable development, anything related to climate change, clean tech, as well as healthcare and biotech. So that hasn't stopped, and that actually has been increasing predominantly. I expect that to increase even further. Problems that had caused this slowdown had to be with geopolitical instability, as we all know, as well as interest rates, U.S. elections that put a hold back on many investments from our perspective. But I think as the year looks more promising, we're definitely going to be deploying capital and trying to avoid selling off some other companies, which was another trend that was happening in the middle markets, where a lot of companies were forced to sell their positions due to the lack of financing that they were not getting, and the fact that they needed to have liquidity in order to continue financing many more companies. That became an opportunity to us for roll-ups, and we did many of those. And again, 2023, we only saw about 90 IPOs, and that was a bad sign for that year. We'll see how 2024 ends. It's not likely going to be much better, but hopefully 2025 will be. So we're expecting that data as well.
Yeah, excellent. Anything to add or?
Yeah, I would just say that I think if you look at like I always like to look at things in vintages when it comes to private equity. So the 2020, 2021, 2022 vintages were purchased at valuation multiples that were extremely high, right? And so the owners of those assets now cannot sell them at the same multiples that they purchased them at. And so they're fighting with trying to grow in a high interest rate environment with the fact that multiples have contracted. So my view is that what you're seeing is the slowdown that we all saw, and we're still kind of seeing, has to do with a lot of those vintages that need to come to market. What has happened, which interestingly enough, is you're seeing a large secondaries market form because of some of this illiquidity and PE firms looking to exit at least anything they can. Otherwise, they have to return capital. And so it's creating a unique opportunity, I think, particularly in the secondaries market, to be tapping into that. And so we're actively looking at, sort of secondary situations coming out of growth equity shops, coming out of buyout shops. And they're done quietly. They're done proprietarily, which is nice, right? And you can kind of get it done without having to be in a competitive process. So that is one area we're focused on even going into this year. And I think it's going to be a good area to focus on. And then on the venture and growth side, we kind of play a lot at our shop because we're industry focused. We're not generalists. And so we think there's a pace to be had for playing on all stages of companies. And what you see right now is a lot of the venture capital backed companies and growth backed companies can't get their next round because the markets are not conducive to investing in high risk assets. When you can go and get a muni bond and get a 10% return on a tax adjusted basis, why would you ever go to a venture, right? And so I think it's creating a unique opportunity there as well to be able to pick up actually what are high quality companies backed by high quality management teams, but are unable to raise capital. And so we have been actually approached by quite a few different, again, proprietary deals, and you can have your pickings right now. But, I think the key is to having the right relationships in order to get access to those.
So, and what I hear you pointing to is really some new strategies just in this market. So I wonder if there's any other thoughts from our panelists, just in terms of what strategies are you employing at this point in time that might be a little different, or especially going into this new year, what that looks like.
Well, new strategies. I had said earlier,
Yeah.
any companies that we find that are ready to go to be implemented or integrated directly to what we already have built, it optimizes our businesses. But mind you, whenever you do new tech integrations, there's a lapse of time that has to be taken into account, and typically that's 9 months to a year and a half. It's not automatic, it's not automated, it's not none of the sort. And I'm talking from the advanced manufacturing point of view to telecom and even to the hotel businesses that were involved. So take that into account.
As far as kind of new strategies or things, we constantly think about sourcing, because sourcing's a big skill set in this. We don't really participate in auctions at the lower middle market of stuff we're looking at. We're typically our founder-owned businesses, and we're directly in touch with the founders through a relationship and things of that. We like this space because we think there's a lot of structural alpha. There's 350,000 American businesses between 1 and 5 million of EBITDA, and most of these are founder, family-owned, and are going to need some succession plans and everything. So the question becomes, how do you get to them? And that's been something that we've been thinking a lot about. So we've developed a couple of strategies around that. One is we have outsourced calling programs with groups, buy-side groups, buy-side advisor groups that go and call on your behalf and get founders and owners on the phone. They may 9 times out of 10, they're not interested in selling at that moment, but you develop a relationship. The other thing we are doing, and it comes on the heels of the panel we just had in terms of AI. AI has gotten really good at helping with sourcing, everything from gathering information to even doing the initial outbound outreach phone calls. I've been on calls where you couldn't tell the difference between a human and AI robot calling a founder. It's kind of wild. And then they train on these types of phone conversations. So we've been playing around with that type of things. And the founders get a kick sometimes. Hey, by the way, that was a robot calling you. And they're like, how did you do that? That's pretty wild.
Excellent. And Jack, I don't want to forget you again on Zoom.
Thank you. No, I'm actually just going to kind of reiterate what some of the panelists have already said. By the way, I think it's an amazing panel. Marty always does a good job of pulling different folks from different backgrounds, but I think this array of different approaches and where we're coming from, I think, is great. In the past, this last year, for the first time, have brought on someone that is overseeing lead generation by taking a number of databases and using a group out of India to data mine, and then a group out of the Philippines to data cleanse. And then there's someone in Canada and someone in Germany that's doing outbound direct reach. But one more recently, I've added to that, and it just goes to the last panelist. We're now starting with, there's a group in India that's implementing AI to help with that data mining process, because finding early stage companies is hard. There's no public directory that makes it easy. They'll give you some sense of, what revenue is and what EBITDA is and how many, it's really challenging. But using AI makes things a heck of a lot easier. I'm a big proponent of AI, although I do want to show a book. If you haven't seen it, it may have come up in the last panel. Book is brilliant, highly recommended. Go find it. The author of *Sapiens*. It's a terrific discussion of where AI is going. But I'm a tech guy, so it's been a hell of a lot of fun and really interesting. I'm using some of that same technology actually to find the best sources of capital. I use family offices, institutional investors, and the like. I found it very helpful to really key in on groups that would be the most interested in the types of deals I'm bringing to market.
Yeah, I got a question here.
Question. So when you guys are structuring your outreach, are you doing kind of a event-driven structure? Right? Like, I mean, how do you know that somebody fits in to what your, most likely candidate is or client is? Right. I mean, so you're saying, well, give me a list of all the companies in the United States that has crossed $1 million EBITDA, boundary, where the owner is older than 60 years old, or, like, what kind of criteria are you coming up with? How are you doing that?
Yeah, I'm happy to start. So I kind of look at sourcing across kind of two ways, right? There's the reactive, something comes your way, you look at it, especially when you're a specialist in an industry, everybody kind of gets to get to know you, you just get stuff no matter what. And that's a lot of what I have just because of that. And then the other way is the outbound approach, which is what I think you're asking about. And so on the outbound approach, it's all about developing an investment thesis to begin with, right? What is it that you think is going to happen in the next 5 years, where the trends support, whatever it is, thesis you may have? You formulate a thesis, find out what other companies in there. And then it is literally like grinding, going and figuring out who are the different owners, who are the different companies, where does a relationship exist? If, it's all about warm intros. I think that usually works the best way to get your foot in the door. And so we do a lot of that. And then you'll go on a roadshow and you'll talk about what it is you want to do. And, I'll tell you what, when you have an idea and you have vision for what you want to do in a specific vertical, and you go pitch that to the various companies that are in the space that may or may not be doing that, you're bringing something to the table that nobody else is. And when you have something to offer, you have leverage. And when you have leverage, they're going to want to work with you. So case in point, I'm not going to go into too many details, but there was a $300 million revenue company, tech-enabled staffing company. Normally, an independent sponsor like myself would never be able to get access to that. But I had a thesis that was pretty interesting, and he wanted to work with me. And so we're developing that, going to formulate that, and then go do it. So at least from my experience, that's how you build really, really deep connections within a vertical that you really are excited about. And rather than I don't do spray and pray, right? It's more about targeted, thesis-driven. What is our strategy? How do we achieve it? And then let's go do it together. And I find that's been very powerful.
Yeah, so in our perspective from advanced manufacturing, for example, I can look at all the manufacturing companies, my competitors in Italy, Ducati, Piaggio Group, Guzzi, companies that you already know of, since we're in the same business. However, if I go to them, being that they're so big already, I don't really bring much value to them. So chances that they're going to be not too nice to us are pretty big. So I'd rather go to the middle market, the small guy, and knowingly that they have the facilities, they have the equipment, they have the staffing, they have the experience, I'd rather make an investment with them and do a roll up in a way that it becomes more of a takeover. I bring you an X amount of volume per year, but that quantifies into ownership into your company. So with a very small investment, really my company positions in a way that it takes over that facility and it expands our global business. That's what I'm doing in manufacturing. That seems to work. It's the same thing in telecom. When you're a small guy and you're subcontracted as, by Wayne, T-Mobile, or whoever it is, those guys can monopolize the system. They can change the rules on you. They can do anything on those contracts. And so how do you leverage that position? It comes down, I listen to them. It's a numbers game, but it's not. It really comes down to the relationship that you can build with those people, those owners, if they like you, they don't like you, and so forth. So that's the strategy we play.
Yeah.
One thing I would add, and actually touching upon the last two panelists, both of them, Um, one of the other ways I source, because you have to have multiple techniques and methodologies for sourcing opportunities, is I use specialists. So, I have a relationship with some former members of, Unit 8200 in the Israeli defense military that, are really some of the biggest experts in cybersecurity in the world. You need to have those kind of relationships to really find opportunities that might not otherwise be uncovered. The other thing, Marco, I know, invests internationally. There are opportunities throughout the world. And again, I'm a I'm a technology guy, and technology is not just developed in Silicon Valley. Right now, I mean, I was looking at a deal in Turkey, and ultimately decided too many of their sales were in Turkey. And considering the geopolitical situation right now, it's probably not the best time to be investing in Turkey. But I'm looking at a deal right now in Ireland, and Ireland is booming. A cheap labor force, no taxes or very low taxes. The relationship with the EU is wonderful. And so there's opportunities, not just in our backyard, but, really globally that you really need to take advantage of.
Yeah, excellent. So the other question that I have, and we're getting a little bit of feedback here. The other question that I have is just, and you touched on this a little bit, but what particular verticals are you interested in, or runways, or where are you headed?
Well, right now the whole PE world is really becoming a pivotal, innovative turn into everything that we're looking at, from the integration of AI into our systems for example, inventory management systems. They're very, very complicated, and we're looking at AI to help us that. I don't know if anybody's familiar with these services, this type of systems, but how do you catalog millions and millions of parts and components that you're buying from various suppliers year after year? Because the one thing you do not want to have a problem with is being out of stock or too much stock, because that will cost you money, right? Inventory. So creating these QR codes, creating systems that are global, placed in iClouds. Another position that we're taking into, for example, data centers. Everybody knows that big data, it's a huge investment, but that in result is creating a major problem with the carbon footprint in the world. So we're looking at solutions that have been devised where you have space data centers in satellites. And that's something that NASA, SpaceX, and also Leonardo in Rome, it's promoting, and we're definitely going to be taking part of these sort of strategies that are looking at long-term solutions for any type of impact investments.
What about my other panelists here?
Yeah, for us, there's a bunch of areas that we've been focused on recently. We had a pretty we've been pretty successful in the pet space. So we had a veterinary roll-up that we sold and did pretty well there for our investors. We have another pet roll-up that we're spending time on. It's in the pet services, boarding, daycare, grooming, and training. And we're buying small pet boarding businesses now. We're up to 25 of them in 10 states. It's probably the third largest in the US now. I founded the company at the end of 2022. We did our first acquisition in 2023. And now we're up to 25 across 10 states, and we're going to probably double again. And so we like areas where there's some sort of pricing stability or ability to raise prices. So some elasticity, inelasticity in that. And people love spending money on their pets, and they also love spending money on their kids. So we're actually spending time right now on an early childhood education roll-up or private preschools as well too. So we spend time on essential services, not just consumer essential services, but there's a couple others that we're looking at in the home services space as well too.
Yeah, on the healthcare side, if you look at the Trump administration and kind of who they're recruiting, where they're going, I think there's going to be an expansion on the MA plans, which is Medicare Advantage plans. You're going to see continued investment and support for that. I think one thing that all prior administrations have lacked is a belief around or incentivization scheme around prevention. You know, we are a healthcare society that is designed around treatment of sickness or episodic care, as the term's used in healthcare. And the reality of the matter is, if we want to improve, without be getting on a soapbox, but if we want to improve healthcare, it really needs to be a much more holistic approach, and the economic incentives that are in place need to reflect that. The Trump administration is 100% on board with that. We know that because I'm working on a deal right now with one of his former human health secretary. So I can tell you that there's going to be a lot of emphasis around this. And so as we think about where to invest, we're looking at innovative programs which are designed around that. And so right now, actually, the deal we're about to close next week is a direct primary care business. We think that area is going to be an increasingly hot area of investment because it is so focused around prevention and care and in driving care in the most appropriate care setting, not the hospital. And so we think those type of models are going to be highly successful. And we're already seeing it. I mean, our company, you know, they were 3 years ago, 1 million of revenue, and they're on track to be around 34 million, and they may be at 53 by this year, just 3 years. So I think, you know, you're seeing this hyper growth kind of situation because it's the market's demanding for it. It's long overdue, and I think that's where we're spending a lot of time. So self-insured employer market's another area we think is really exciting. DPC kind of falls into that. There's a lot of other ancillary services that sit around the patient in that market. It's been largely untapped by private equity. I think the opportunity is there because of that, and so we're continuing to invest there while multiples are still not crazy expensive. Other areas of interest for us in healthcare, generally I'll tell you what I'm trying to avoid. We're trying to avoid home health. We're trying to avoid, anything that it's got regulatory risk attached to it in a big way. And a lot of folks are saying, oh, the 10,000 seniors a day, let's go chase it. Reality is the government can't afford to pay, keep making payments, right? And so we just try to avoid those kind of areas. And I think on the healthcare IT side, lots of innovation ongoing with AI, still early innings. So another area we're actually trying to avoid. I think, the best way to play AI is to play on the supporting technologies. Don't be the guy who's looking for gold. Be the guy who's helping the guy who's looking for gold, right? That's how we like to invest in healthcare, broadly speaking. I think AI, as you think about that, without going too much, there's a lot of players, a lot of areas to play there, and you can do incredibly well and stay under the radar where a lot of the PE firms and venture firms don't see.
Great. Jack, do you have anything to add? No.
No,
Okay.
I think I think they've covered it. I'm pretty happy with the answer so far.
Excellent. Well, can you all speak a little bit to just how you're navigating some of those valuation challenges as you move through this?
Well, valuations depends on many different things. When we're buying companies, give an example right now. There's a racing track in Italy that we're looking to buy, a very important one. The revenue line on this is 3.5. The EBITDA is 1.2 million euros, and the guy wants 21. Does it make sense to you? So exactly. So there are people that do not understand valuations at all because they don't have the information. They're just too old school. And then there's the bankers and there's the finance people that do understand how things are leveraged. So there's a fine line between that. We're hoping to get this racetrack, and then we'll be making that announcement for all of you guys to come to Italy and enjoy F1 racing with us. And hopefully it'll happen this year. But valuations coming down to that, it comes down to the person really. And if there's a real firm behind your company's doing them, still you got to have enough room to negotiate with new money if you're looking for equity. If it comes down to debt financing, everybody wants to give you a loan for 100%. Don't take it, because that'll kill your business.
Yeah, let me.
It's been an interesting year. Valuations we would have thought with with higher rates, valuation expectations from sellers and things would have come down. You know, our perspective is really purchase price matters. So we're pretty disciplined about valuation. We're not chasing stuff. We have gone up in quality of business. So we will pay up for quality of a business if it's growing nicely, if there's a good management team and everything. But even then, we're pretty disciplined about, you know, where we're stretching. I don't think you'll see us pay north of 7 or 8 times EBITDA for anything. It's just we think it's really hard to make money when you start paying double-digit EBITDA multiples in general. That's, you know, I've seen people do it, but you know, for us, we're kind of disciplined about what we're doing. And at the lower end of the middle market, valuation creeps has happened. We've seen it. We've seen sellers. We were under LOI on a deal in the roofing space. Was doing, when we underwrote it, was doing 6.5 million, 7 million of EBITDA. We had it under LOI for 6.5 times. The business subsequently during the Q of E, it actually grew and was run rating closer to 10 million of EBITDA. The sellers knew that, even though we didn't share them the Q of E, and they came back to us and said, not only do we want a higher purchase price scalar wise, they actually said we want a 10 times multiple, because they went to a conference and heard that PE guys were paying 10 times multiples for roofing and HVAC businesses. So it's kind of getting out of control a little bit. You're gonna have to step back and be like, okay, we got to just stay disciplined and find good assets that make a lot of sense. But there's no easy answer on that.
Jack,
I generally don't invest in distressed. It's not something I want to be doing, but I have been coming across a number of technology companies that received early funding at valuations that are untenable. Then you have to be a lot more creative in terms of structure, you know, putting some kind of participating preferred, you know, perhaps with an accumulating dividend, or you know, a cram down, you know, of prior investors, because they've overvalued the business. And if the technology has some value, you know, you got to make it clear to the sellers that, look, I could bring some value here, but you've got to come down to a point which is realistic in terms of where this company can go.
excellent. So I wanted to turn it over to the audience and see if anybody here has any questions for our panel.
So, you know, I guess we were talking earlier about like Elon Musk and people, like there's a private equity firm that's backed a lot of this. Have you guys ever thought of attaching to somebody who just will just create one new great company after another? I mean, some people are great salespeople. They're just built to front a company, right? They might not be Mr. Operates to I think Elon Musk is a pretty good operator, but I mean, they're just great at selling the latest company, right? Have you guys ever thought of that as a strategy? Like, I just lock on to this one guy, look, the sky's the limit, literally.
I certainly have. So I took the liberty in September to writing an executive letter as the chairman of my holdings family office to the whole board of 2 companies, one Tesla being, and the second one, Lucid Motors, explaining to them how we're positioning ourselves in Europe and hopefully piggybacking on everything that they had done from technologies to what it is. As a result, unexpectedly, McLaren came to the table. So Soriano Motors Group is in business with McLaren USA starting 2025.
Nice.
It's a huge, thank you. Happy to make that announcement, and there's a lot more crazy things to happen. You put me in front of Elon Musk, I don't know if we're gonna be friends socially and all, but you know, we manage. I think all kinds of weird people in the world these days, and we have to just figure it out.
So like,
I got along with these
like
guys. It's
Antonio,
okay.
like Antonio Grassi from Valor Equity, like, you know, he just backed Musk on everything, right? Musk like, I'll finance it, don't worry about it, right? I mean, have you guys thought about that approach, or?
Yeah, part of the reason I'm here is to see you, Marty. I know you got your family office. I'm thinking about latching on with you, going to the moon here.
But yeah, but you misinformed me on Bitcoin, but anyway.
Look, I think, you know, in healthcare, what you'll find is it's a relationship business, highly relationship business. It's a very people business. And so what happens is as you kind of as you over your career, meet a lot of folks, and you start to find out who's good, who's not, and what they're good at. It's not like who's good, who's not. It's really what they're good at. And you sort of, you do tend to want to bring those people into companies you acquire. So I would say, I don't know if I hitch myself to any one person, but
Yeah, because you can do that in private equity and you really can't do that in venture. Once you've funded somebody in venture to be a success, if they're really successful, you'll never see them again, right? Because they just outgrow venture.
You do need an investment program. And if you have one team, say your team, your people, and you can back the same client year after year
Over and over again, yes, right.
to finance receivables, for example, production after production, that's your winning ticket. Yeah. So you should consider putting money over
I
here.
mean, I just think it's just it's another way of looking at private equity, right? Just the guys who back the winner over and over again. So, Jack?
Yeah, no, I definitely, I've had a few serial entrepreneurs that I stay in touch with them on a regular basis because when I'm looking at a new portfolio company, I will pull them in to help me with due diligence. And I can't wait to hear about their next opportunity because I want to be first money into their next thing. So I don't like put them, I like to have those people as board members. So, I mean, that's really where they can be of significant help to me. And then you keep them close because they're going to find something new and interesting and fun to work on. So that's what I try to do.
Jack, you're kind of in the heartland of innovation there in California and Los Angeles. I mean, state. Do you guys position yourselves in terms of geography and what you're looking at? I mean, sorry, I think you were looking at roll-ups at one point in time.
We do. We're looking at in geography wise for the roll-ups, we're looking at the 20 fastest growing MSAs, which are typically in the Southeast and Southwest. We're not really, but in some of our roll-ups, our pet roll-up, we're geographically, agnostic because we're in 10 states. We actually want to go to as many states as possible. One of the things that we have avoided is investments in California. It's funny, but it has become such a challenging environment to operate any type of, cash flowing, roll-ups or frankly, any investments in California where labor is a portion of it. Technology is different, but if you're doing roll-ups or you're doing things like that, California where overnight, they were talking about changing laws to labor. I think they vetoed a healthcare law, where they talked about private equity not having any interest in healthcare companies. It's such a wild west. That's one area we have somewhat avoided.
We are not friends. This is the fifth largest economy in the world. We have agriculture, we have the film industry, we have the tech industry, we have military here, we have everything here. The fact that you're not investing in it, good. It leaves me more opportunity. Jesus.
I just said it. I think Jack used to work. I think they worked with Kane Anderson, right? Before he was a manager.
I was with Kane Anderson.
And Kane has always had this great formula of saying, we don't care where we invest. We think there's a lot of undervalued managers that aren't in California, like in Oklahoma at a university or Texas or Cleveland, Ohio, or something like that. And they've actually done very well with that philosophy.
I can add, listen, California, it's on our radar. It's definitely a legislative issue sometimes, but we have done some very good connections there. Like ultimately, we started a cybersecurity company called Resilience, and the former governor of California, Davis, is part of our board. And he was really taunting me on politics. And I just kept myself very neutral. So it comes down to really staying neutral when it comes to politics. Another one is the Evans Hotels down in Pebble Beach, where I met the guy at the Peterson Museum in LA. He's one of the biggest car collectors in the world, one of the very richest men there, and had a 1926 Soriano Pedroso car, which was built by my grandfather. So I have, by all means, to make these friendships happen, and it comes down to it. But yeah, to your point, it's a difficult place, but once you're in. So Jack, I'm coming to visit you, buddy.
Anytime, you're welcome.
I would say the flyover states actually are quite great places to go and hit up for investments. I think South Texas, nobody is investing in there, and this investment we're closing next week is in South Texas. There's 2.6 million people around the border over there. It's a massive market. No one's investing in it. And so it's amazing to me, actually, what you can do. It's hard to find talent, in all fairness, but it's a great place. And so, again, flyover states, or you can find undervalued assets and do pretty well. And then in healthcare, just if you're in the provider business, and anyone who's in healthcare knows this, it's all about geographic density. So you plant a flag in a state, or you plant a flag in a city. You don't go to the next city. You build as many clinics you can within that particular city. You get payer reimbursement. There's all kinds of reasons why, but that's how we think about geographic investing.
Lack of capital means they have to be more fundamentally sound. They have to be better managed.
Yeah.
Professor Shelley?
So the one thing you hit on just very briefly was just politics. And so given the new administration, I'm just curious if anybody has any thoughts. I know we touched on this a little bit earlier today, but
Listen, I live in Nassau County in Long Island, where everyone is Republican. I'm a capitalist. I like to make money. We're usually the first money in to create real jobs. Does that mean that we have government support in any perspective to make us invest more and more? Absolutely not. Do I tap into government fundings, for example, in the EV sector? It's impossible to get this funding. So it doesn't stop me. We as a family office, we have to think 10, 20, a whole generation ahead of us, not 4 years ahead of us. So that doesn't really make much difference in my thesis.
yeah. What about the rest of you?
I mean, in healthcare, the reality is there's certain trends that just keep moving forward no matter what the administration is. So, I would say politics is of concern. We always are paying attention to it, but if you invest appropriately, you can kind of avoid pitfalls of a new administration.
We are cognizant of it. But we're capitalists. We're looking for, invested returns on capital and everything. But one of the things I would point out is there's been a tremendous amount of private equity going into blue collar type roll-ups like HVAC, roofing, plumbing, things like that, where there's a strong dependence on labor that may be undocumented. I think that's going to be interesting to see what happens there if there's challenges in those types of environments. We're pretty careful about that, but given what has been verbally talked about with the Trump administration, I think that's going to be interesting to see how that impacts. I mean, you have huge private equity firms like Alpine and others that have invested a ton of money and built enormous platforms in these blue collar roll-ups. And so I'd be curious to see what happens.
Talking about roll-ups, I get a lot of people come to me with roll-ups, like a lot of dental roll-ups or primary care roll-ups, stuff like that. And I'm just wondering, and none of them seem to be very disciplined. Like, I'm like, so is there a hurdle that you have to achieve to make sure you're being successful? And none of them talk. I'm going to get economies of scale. I'm like, well, right, but at what rate of, do you guys have rates of return that you program into what you're trying to achieve when you're doing a roll-up? Are you looking at, these kind of acquisitions? Or are you like saying, well, for it to really be a success, I need to get 15%, right? Or, what are your thoughts?
Yeah, I mean, it comes down to, we start over. Depending on the roll-up, every roll-up is going to have its own thesis. So what I like to do is build ecosystems of companies that service a patient. So our strategy actually results, it's not about same store sales growth, which a lot of these like roll-ups in healthcare were focused on. It doesn't work. Doctors aren't going to work harder. I'm sorry. Especially if they're owned by a PE sponsor. So
Cultures are different.
Yeah, completely. So you have to preserve their culture and understand they are going to treat patients the way they want to treat patients. And if that's your bottom line understanding, then you got to develop a thesis around that. So I like ecosystems. You get a patient, how do you own the relationship? You own the relationship by owning the doc. Once you own the relationship, you own the referral. Once you own the referral, Now you can go into all kinds of other verticals that service that same patient and refer to yourself. Now we're private equity, so we have safe harbor. We keep arm's length transactions. So it's actually quite remarkable, and you can drive incredible value for your investors by doing it the way I do it.
I'll just say, we're looking to make a 3 to 4x MOIC over a 4-year period. So where does that deconstruct into? There's some earnings growth on same store sales level, but if you're buying stuff at 4 or 5 times EBITDA and you get to scale and you can sell at 10, 11 times EBITDA, there is structural alpha there, and you can see those types of returns. In one of our roll-ups, we were buying stuff at 4, 5, 6 times EBITDA. When we sold the platform, we sold at 22 times EBITDA. We made 11 times our investors' money in 3 years. So you can get these types of venture-like returns without venture-like risk because you're buying cash flowing assets. But that game is starting to get competitive as well too, the multiple arbitrage game. But I think they'll continue for some time, because there's just a lot of it's a target-rich environment. Like I said, depending on areas and everything, there's thousands of these small businesses that are out there that are family-owned, founder-owned.
So I'll give you my 2 cents.
Okay.
I have friends and investors that are in dental practices, medical practices. They all are typically starting their first generation family offices because they have a lot of disposable cash. We hang out. These guys work like dogs. They hate their lives. It's really unlikely that you'll find a doctor or a dentist that says, I really love what I do for a living. Because after 20 years of doing that, they're eager to sell their practices. And I think this is where the opportunities lie. But how much can you really make those guys still work at the point in their lives, they're 50, 60, they already have a lifestyle that is really a good one. They want to just have fun. You got to bring them fun investments.
Are you seeing more prevalence of like earnouts and owner financing?
Yeah,
Yes.
definitely. You're seeing that a lot. Structures, and whether it's healthcare or not healthcare, you're seeing.
Yeah, I mean, on our most recent deal, we have a highly structured deal. It's there's like a whole share return based on revenue thresholds met for 2025. So we're getting in at a typical market multiple, like a low multiple really, and they have the ability to make a lot more money. So and we've got like a special option plan. I mean, it gets creative, and you can do that as an independent sponsor, which is great.
Yeah, I want to give Jack a shot here.
No, as Marty, I think Marty knows, when I was at Kane Anderson, we did some medical practices, and my general warning is doctors are a huge pain in the ass. Yeah, they're really, really smart folks, but boy, are they terrible businessmen. And so I would go in back to that space with some trepidation because you are dealing with some human beings who have enormous egos. Sorry.
And Jack, how about on special, are there any special negotiations that you have today that weren't available 3 years ago when markets were frothier, like earnouts or clawbacks or things like that?
Yeah, no. I mean, absolutely. Being that the markets are tighter in terms of investing in these spaces, and if you find an opportunity with a company that, a group that's interested, I absolutely will use every trick in the book. And I do have a lot more arrows in my quiver to negotiate. One of the advantages to being a former lawyer is you come in with a few things that they probably didn't teach you in business school. And so I definitely go in there with the expectation that I'm going to have to use some more bells and whistles in order to get the deal done.
Anything else, sir?
Why don't we find out the other questions from the audience?
We got a
Yeah.
man that wants to challenge us,
No.
the lady.
Is it a doctor?
Are you a
So
doctor?
married to
You
one.
need the mic? Can you go ahead?
I'm running a health tech startup in wound healing, and I'm originally from Ukraine, and the part of our R&D is in Ukraine. It's going stay there because from pricing, for example, because unfortunately, because of war in Ukraine, we have possibility to test very fast, like new features and new products. And my question is like, Ukraine is under war, so like it's a big risk to have like even a part of R&D in Ukraine. What do you think about investing in such companies that have like part of R&D or any other like, I don't know, assets in?
I looked at a company in Ukraine a year and a half ago. One of the key programmers at the company died. It seems like most of the tech folks have moved to some of the Baltic countries, Estonia, Latvia, or Lithuania, just because they have to. Right now is a really, really challenging time in that part of the world. I was heartbroken about the loss of the opportunity, because the person they lost was really of key talent at the company, and I had to walk away.
In our case, we relocated 21 of our software writers into Italy because we're based in Italy, and Italy has a law that actually accepts people in war zones. Some of them are in Spain, and other ones are also in France. So we've sponsored them through our companies in order to maintain the talent. But to keep talent there working, it's right now, until there's a geopolitical stability reached, it's not possible. I wouldn't look at it as an investment there, but I will get them out of there and have them with us for sure. 21 of them from the Ukraine work for us.
Yeah, anything in Ukraine is a reconstruction issue, I think. I lost a tech team in Ukraine, right? But in Israel, it's just as bad. I think
Just far away.
Ukraine
is right there.
In Israel, people have been called into service who work for these tech companies, right? And then at the same time, a lot of manufacturing has left Israel to come to the United States, right? So I just think that until war's over, it's fog of war.
We'll see what
And
happens.
making a decision, why would you be the first one?
You had a question back there, sir, with the TikTok.
Sorry, can I add like one thing? So like, but if it makes sense because of war, I'm not saying like all the R&D or all the team, but the part of R&D, just like to give possibility to test the product fast, because it won't kill it. It's tested by paramedics, tested by soldiers.
I don't know, that's more your expertise.
Yeah, I wouldn't be able to comment on that. I invest entirely in North America, so I just don't have the expertise of working with Europe.
What's your other question?
One last question and you get free lunch.
Fantastic, great job, guys.
Thank
Thanks so
you.
much.
Thank you, everyone.